Hello, everyone. Today is May 6th, 2025, and this is your 314 SMI investor update for the month of May. Fernando, how are you doing?
I'm doing well. We had a wild April, and thankfully the fun survived.
Yeah, for sure. Yeah, this is the first update we're doing like this. And so who knows how it's going to go, but we hopefully do this every month for anyone who's investing in the funds. We're just curious to see what's going on. So why don't we get into it, talk about what some of the drivers were for the family of 314 SMI funds. We're going to start off with FCTE. The FCTE is the ticker symbol for the ETF. This is a 20 stocks equity ETF. It's 20 stocks, equally weighted, rebalanced every month. And so we rebalance back to an equal weight every month. And we select the stocks within the portfolio based on a two-step process, really. The first step is to scan the S&P 500. That's our selection universe. For the top 100 stocks based on quality, that's a proprietary quality factor that 314 Research developed over a number of years. And then after you find those quality stocks, you overlay a trend process. So we have a quality universe, then we're going overlaying a trend process. And the trend, to make a long story short, is we want an intermediate to long-term uptrend and then a short-term pullback. And so that's the underlying formula. If anyone's interested, we have white papers on the underlying model that you can get. But that's what the FCTE, that's how it operates. And so it's 20 stocks, quality-based, trend following as well. So what happened in the month of April? Well, I mean, what didn't happen in the month of April? It was a crazy month. We had tariffs, we had a pause in tariffs, we had the 10% day in the S&P 500, basically hit bear market territory in the S&P 500. So it's kind of a crazy month to start our first fund review and investor overview. But when you look at the actual numbers and you zoom out and say what happened for the month, it kind of hides all that turmoil that happened. So the S&P 500 was down about 0.7% for the month. S&P equal weight was down 2.3% for the month. FCTE was up 0.84%. So you got to be pretty happy with the performance through all that tumult that we had in the month of April. The chart we're looking at, or the slide we're looking at here, is a performance attribution slide. Fernando, do you want to give us a quick overview of what we're looking at?
Yeah, so on the left, we basically have a ticker level contribution to the overall portfolio's return. So if you sum all those numbers in each of those bars, and the red ones are positively contributing, and the red ones are negatively contributing, detracting from performance, you sum up to the portfolio level return. So it basically tells you which tickers drove the performance and how much came from each one. On the right, you have the same thing broken out, taking those tickers and looking at the sectors that they're members of, so you can see which sectors kind of drove performance.
Yeah, so what you can basically see is the sectors that contributed a positive returns to FCTE in the month of April: consumer staples, industrials, and tech. And then you had materials and discretionary and a couple others that detracted for the month. And so those were the drivers. That was the breakdown. Let's move on to the next fund. The other fund in our universe is the RAA ETF. And this is a totally different ETF. A lot of people say, what's the difference between FCT and RAA? FCTE, 20 stocks, equity, long only strategy. RAA, totally different animal. RAA is an asset allocation fund. And so it is kind of the new era way to automate your asset allocation and expand your menu of potential assets. So there are 20 assets you can go into, that the fund goes into. It's based on a model that 314 Research developed and has been running for a number of years. So 20 assets, benchmark weights, and then trend following and other factors, volatility and correlation that dictate how you tilt around those benchmark weights. So what happened in the month of April? Again, RAA up just under 0.2%. So again, a lot of volatility within the month, but from point A, from this begin to the end, doesn't look like all that much volatility when you look at these benchmarks or even the RAA's performance. So what happened? What drove performance? Again, this is the same type of chart that Fernando just described. The left-hand side is looking on the asset level, the individual asset level, and you can see that it was not surprising. The Bitcoin, NASDAQ, and gold allocations within the fund is what really produced the positive results. Energy held us back a lot. S&P 500 and dividend payers also were detractors from April performance. The right-hand side is looking at this on the broad asset level. And so unsurprisingly, it's alternatives. That's where Bitcoin lives. That's where gold lives. Alternatives were really the big driver of performance. Fixed income and equities overall both detracted from performance in the month of April. So not surprising. Let's look ahead and see where are the weights for the month of May. So this is a table that kind of gives you a snapshot of what the model has done, the RAA fund has done, and what it's going to be doing uh, for the month of May. So starting on the right-hand side, that's the max weight for each asset that's available to this fund. And then you can see how weights have evolved starting for the month of March, which we rebalanced on February 28th. So that's your March date. And then the month of April, where we rebalanced at the end of March. So, and then finally the colored cells to the second to the left column, you're looking at the current weights for the month of May. So what's the message? It's kind of interesting. So you can see that after being overweight for a couple months, the fund is now significantly underweight equities. So equities go from a 52% weight. So again, you can see that that's against a 50% benchmark in the benchmark column in the month of April, and now down to 34%. Offsetting that big move lower is an increase in fixed income weight. So fixed income goes to 41%. That's a big overweight. And alternatives goes to 25%. Within the individual assets, one of the biggest movers was managed futures going from a 1% weight to an 8% weight. Gold is still a massive overweight at 6%. Bitcoin is maxed out at 3%. So this model is saying we don't really want equity exposure in May. We want to keep running with the monetary alternatives that have been working primarily, the hedge that is managed futures, and then let's add on some fixed income exposure. So let's go to the next chart. This is just putting the big dramatic downshift in equities in historical context. So this is taking the underlying real asset allocation model weights over the last 2+ years. This goes back to 2023. The bars are the overall equity weights for each month of the year. And the purple bar represents May, where we're at right now. So in May, that weight has dropped to 34%. That's 16% below the benchmark weight. And the horizontal dashed line is drawn at 50%. That's the benchmark weight for this model. And what it shows you is that really for the better part of 2 years, the model has been overweight equities. It has been a bullish tilt to the allocation. And you have to go all the way back to April of 2023 to find a month where equity weight was lower than it is for May of 2025. So more than 2 years ago where we had this kind of equity weight. So it's a big move. The model obviously doesn't like what it's seeing within the trends of the market. Doesn't mean the model is going to be right, but this is a trend following. This is how trend following works. So once you see those trends deteriorate, you start dialing back exposure and adding exposure into the areas that are working, like gold, like Bitcoin, and then that are uncorrelated as well, like managed futures. And so that's what the model is supposed to do, and that's what it's doing for the month of May. Fernando, before we move on to market commentary, do you have anything to add on the ETF positioning for May?
No, I think it's really good to just highlight RAA and how it differs from traditional 60/40 investing. A lot of times, if a model wants to express a defensive position, basically loads up into bonds, and RAA is very differentiated from that because it has this alternatives asset sleeve that it can use to, if you're going to take away from equities, it doesn't all have to go into fixed income. You've got that alternative sleeve that we're seeing definitely being used by the model coming into this May allocation. So good to just point that out and highlight that that's one of the key aspects of the RA framework.
Excellent. Yes. So the second part of these calls, we're going to see how this. We're going to have to find our cadence and see how these things go. But the second part, we plan on having a really quick touch point on market strategy and thoughts. So this is just how some of the things that caught our eye that's going on in the markets. Obviously, we've had a peak to trough. There was almost a 20% decline in the S&P 500, and everybody's wondering, is this the bottom? Have we seen the bottom? Got this big rally off the lows, all this volatility. So a couple of things. Let's look at a couple of things that could help us understand what the base case should be going forward on equities finding a bottom, especially in light of the fact that RAA has dialed down its equity exposure. So the chart on this page is pretty interesting. It shows how these V-shaped recoveries usually take place. And so the blue line is corrections. That's 10% declines in the S&P 500, where the Fed starts cutting rates within 3 months of that 10% correction. The red line are historic cases where the S&P 500 declines by 10%, but the Fed does not cut rates. And so what you see is the red line is a much more muted recovery. The blue line, you get a much more dramatic recovery. The reason we're showing this chart is because, again, we're trying to look out and say, okay, is it likely that the market is bottomed? Of course, no one knows for sure. We can only gauge probabilities and look at history. Well, what history tells us is that to get these V-shaped bottoms and aggressive rallies off of and new highs from where we came down, you would need to see some kind of policy response from the central bank or from the fiscal side. And in our view, it doesn't look that's likely. The Fed has been what we call recalcitrant. They're in somewhat of a fight with the Trump administration at this point in time, and they're frozen due to the tariff announcements. They don't know how to deal with that. So it looks like they're going to be more reactive. They're going to need to see the quote unquote hard data start to decline before they come in and support the market. So the bottom line is it looks like we're much more likely to be following the red path rather than the blue path. And so that's the more grinding it out, chopping around period here. Maybe you retest the lows, but it's less likely that you have a V-shaped recovery and you just go on to make new highs real easily without that policy making support. So let's highlight the most positive thing about this market is the sentiment backdrop. The sentiment has been awful, which is a contrarian buy signal. We mapped that at 314 Research, where Fernando and I do research, and so the research company we founded, we map sentiment in a lot of different ways. We look at retail sentiment through the ETF market. We look at institutional sentiment and different models for managing risk on the institutional side and what it suggests for positioning. And essentially, we saw a really good sentiment washout in April, which we translate as you can't de-risk when sentiment's like that. We pulled out one chart from our studies that we thought was particularly interesting, and that's this strategist target chart. We've shown this before on social media. Basically, what we're looking at here is the median Wall Street strategist year-end target in the purple line and how it has evolved versus the S&P 500. And the bottom line message you take from this chart is that going back to 2023 through 2024, strategists were cautious. They kept their targets right on top of the S&P 500, which is abnormal. Usually they're about 6 to 8% above the spot S&P 500 market. And then when we came into 2025, these strategists boosted their targets way above spot S&P 500, and that indicates excessive bullishness, which is oftentimes a negative for the market. Well, as we went through April, we had this sell-off. You've now seen strategists dial their year-end targets down significantly in recent weeks. This is usually a good sign for the market. In general, just to summarize our research, the market tends to bottom within that 3-month window after you see strategists bring their targets down this aggressively. So we're in the neighborhood from a sentiment perspective where we should expect some kind of bottoming. We still don't have the policy making support from the previous chart to set that low necessarily, and neither do we have the technical confirmation. So the other factor that we're watching from a strategy perspective is the economy. Is the economy going into recession or not? So we look at that a few different ways. One of them is on this chart. We like to look at real-time indicators in this period where you're going to have a dramatic change in economic data as we pass through the tariff window. You're going to have this where the data pre-tariff and post-tariff is going to look totally different. So it's hard to rely on the traditional economic data that runs with such a lag. So what we're looking at and relying more heavily on is things like credit spreads and forward EPS. And so this is a chart of forward EPS for the S&P 500 around equity corrections. So the purple line are equity corrections where the economy doesn't go into recession. And not surprising, you see forward EPS continue to track higher in those cases. The blue line are cases where the economy enters a recession, and forward EPS estimates fall apart in those cases. So it's important to see what case are we tracking closer to as we move through this earnings season. And so far, what we've seen on a headline level is forward EPS start tracking that recessionary path. But what the real wrinkle of this chart that's interesting to us is that when you strip out energy, it doesn't look nearly as bad. The solid line here, solid red line, is X energy. And you can see that when you take energy out of the forward EPS estimates, that line looks like it's starting to stabilize and maybe even track closer to the purple non-recessionary case. Energy, bottom line, has contributed 26% of the decline in forward EPS estimates because of the collapse in oil prices. And we, in sum, are not worried about the collapse in oil prices signaling anything systemic about the economy. It's really an OPEC supply issue. So this is ultimately an encouraging chart, at least for now. We haven't seen the evidence of a recession. And so therefore, we don't see any reason to get more cautious on the markets quite yet. Of course, if we do have a recession, I don't think that it's priced in at 5,600 S&P 500. So that's going to be an ongoing set of indicators that we watch in our strategy work. Fernando, do you have anything to add before we sign off?
Yeah, I think that's it's good to summarize this as there's good evidence on both sides on the direction of equities going forward. Sentiment's in a great place. On the other hand, the policy responses that could help the market bottom are not yet in place. Um, one positive thing that we've had in the recent weeks that explains this last earnings chart here is earnings season has been pretty good. It has not been, there's been not many red flags out there, which is helping that forward earnings estimates line perk up and get back on track. So it's a lot of interesting things to keep an eye on, and the evolution of this tariff drama is going to be one of those things that can just define the rest of the year, essentially, the way that
Certainly.
those cards flip.
When you're dealing with strategy work's fun. It's always important for us to try to piece the puzzle together. But when you're dealing with this much uncertainty, there's nothing better than a systematic process that you believe in for investing. And that's really ties it back to the two ETFs that we started, the two funds at the beginning, FCTE, the equity, long only equity selection strategy, and then RAA. One of the things I like about both of those funds is they're nimble. They rebalance on a monthly basis in a tax efficient manner. And so you're harvesting gains and you're shifting into wherever the strength is materializing on a monthly basis. And so we're going to keep running that process within the funds and watching these indicators at the same time. So until next time, again, thank you for your time. I'm Warren and Fernando. Have a good one.